The S&P and the Nasdaq experienced their most challenging week since March, primarily due to the Federal Reserve's suggestion of potentially maintaining elevated interest rates longer than anticipated by investors, although they refrained from raising rates this month. Officials are striving to curb inflation without triggering a recession. The first half of the year has been challenging for the S&P, with a nearly 3% decline. Nevertheless, analysts remain optimistic about the next 12 months. Wall Street analysts have high expectations for substantial rallies in the next year for 10 S&P stocks, including SolarEdge Technologies, Insulet, and Dexcom, according to a new report by FactSet's John Butters. These stocks are all projected to rise by 62% or more within a year. This is particularly impressive given the high expectations analysts have for the S&P itself. Analysts anticipate a 19% increase in the key benchmark stock index over the next 12 months, reaching 5,152.11, as stated by Butters. This represents nearly double the typical total return for a given year. While analysts may be bullish on the S&P for the coming year, investors may need to endure some short-term challenges. Part of the challenge stems from fundamental factors. The third quarter is concluding, and it has not been a favorable period for corporate profit growth. Analysts predict a 0.2% decline in company profits for the third quarter, marking the fourth consecutive quarter of earnings declines according to Butters. However, optimism remains on Wall Street. Analysts anticipate a 12.2% profit growth for S&P companies in 2024, up from the 11.9% growth forecast in June according to FactSet. Some stocks have the potential to outperform significantly, especially those that have lagged this year. Currently, analysts believe that this trend will change. 8 out of the top 10 favorite S&P stocks for the next 12 months have seen declines in 2023 so far. This is notably the case with SolarEdge, a solar power equipment seller. Analysts project a nearly 114% surge in the company's stock over the next 12 months, which would outperform any other S&P stock during that period. This optimism is not entirely unwarranted. Several alternative energy companies have been among the best performing S&P stocks since the Federal Reserve began raising interest rates last year. Additionally, SolarEdge is expected to achieve a more than 55% increase in profit this year and a 22% increase the following year. However, SolarEdge's stock is down 52% year to date. Analysts are similarly bullish on Insulet, a maker of insulin delivery products for diabetics. Despite a 46% decline in the stock this year, analysts anticipate a more than 77% increase in its value. This optimism is supported by expectations of a 28.9% jump in the company's adjusted profit this year. Analysts also favor United Airlines and MGM Resorts, predicting gains of nearly 70% and 62% respectively over the next 12 months. These projections come on top of their already notable increases this year. While analysts are not infallible, their close examination of S&P stocks suggests that these opportunities are worth considering. You should also know that Amazon is set to invest up to $4 billion in Anthropic, securing a crucial partner in its pursuit of establishing a prominent presence in generative artificial intelligence. This move also reflects a vote of confidence in the burgeoning startup. As part of this arrangement, Anthropic will relocate a significant portion of its software infrastructure to Amazon Web Services data centers and harness Amazon's proprietary chips for training the models that drive its chatbots and other applications. In addition to gaining access to Amazon's formidable computing capabilities, Anthropic will receive a substantial financial infusion, which will aid in covering the substantial expenses associated with training and operating massive AI models. Amazon will hold a minority stake in Anthropic, as outlined in the joint statement released on Monday. Historically, the e-commerce and cloud computing giant has made strategic investments in partners operating in sectors it deems essential, such as cargo airlines, grocery distribution, and electric truck manufacturing. However, if Amazon's investment in Anthropic approaches the $4 billion mark, it would mark the largest publicly known deal directly linked to Amazon Web Services. Amazon's leadership has emphasized that generative AI is still in its early stages. They have reported that over 100,000 customers have utilized the company's machine learning tools thus far. Anthropic's foundational model named Claude was already available through an Amazon service called Bedrock, which is still in its early release phase and provides access to both Amazon's and third-party models. This investment also marks a significant milestone for Amazon's in-house chip manufacturing efforts, featuring processors like Trainium and Inferentia, designed to power machine learning applications. Many advanced AI applications rely on costly chips produced by NVIDIA, which can be challenging to acquire. Anthropic intends to leverage AWS chips for constructing and training future foundational models. Founded by veterans from OpenAI, Anthropic has raised over $1 billion to date, positioning itself as a company dedicated to creating safer chatbots for tasks such as summarization, search, question answering, and coding, which is great news for Amazon. Now let's talk about the standard iPhone 15 model from Apple, which is experiencing significantly longer delivery times this year compared to its predecessor, indicating strong demand for the company's latest smartphones. In the United States, customers now have to wait for 10 days to receive the basic model, up from 6 days for the previous generation device launched last year, according to data provided by Counterpoint Research. On the other hand, Apple's premium offering, the iPhone 15 Pro Max, has seen a record increase in pre-order waiting times, as reported by researchers. Substantial improvements in both models have spurred renewed interest, albeit at the expense of Apple's other options, the 15 Plus and 15 Pro, both of which have seen reduced wait times. In China, Apple's largest overseas market, wait times for the basic version have quadrupled compared to last year, according to Counterpoint. This suggests that Apple is attracting buyers even in the face of competition from rivals. The prolonged delivery times have not resulted in higher resale prices, as the researchers confirmed the reports from Bloomberg last Friday that scalper prices in China are only commanding modest premiums. This may indicate that demand is being driven, at least in part, by people trading in their existing devices. In other news, NIO experienced a decline in early trading on Monday, amid broader pressure on China-related stocks. Earlier in the day, NIO completed its $1 billion convertible senior note offering, and was also the subject of media reports suggesting it was seeking up to $3 billion from external investors. In response to the speculation, NIO issued a statement clarifying its current capital-raising activities, which said the following: "The company has become aware of certain media speculations regarding potential capital-raising activities, which have circulated widely today." The statement went on to say, "Given the unusual market activity in the company's American depository shares today, the company wishes to clarify that, aside from the recent completion of the convertible notes offering on September 25, 2023, it currently has no other reportable capital-raising activities." NIO then emphasized its commitment to transparent and timely communication with the public market, and pledged to promptly announce any material information in accordance with applicable laws, listing rules, and best corporate practices. In other news, MicroStrategy revealed that it had acquired 5,445 bitcoins for approximately $147.3 million in cash since August 1st, and on September 24th, it sold a total of 403,362 of its shares for net proceeds of approximately $147 million. This information was disclosed in a filing made on Monday. This means the company sold shares just to buy more Bitcoin. The share sales were executed through a previously announced sales agreement with Cowen & Company, Canaccord Genuity, and Berenberg Capital Markets, in which MicroStrategy had the option to sell up to $750 million of its common stock. In its most recent Bitcoin purchase, the company paid approximately $27,053 per Bitcoin, including fees and expenses. Under the leadership of Bitcoin enthusiast Michael Saylor, MicroStrategy is one of the few non-crypto mining companies that has accumulated billions of dollars worth of Bitcoin on its balance sheet. As of September 24th, the company held approximately 158,245 Bitcoins, which were acquired for a total cost of approximately $4.68 billion at an average price of $29,582 per Bitcoin. Next up, Netflix has announced the discontinuation of its DVD service, marking the end of an era for those who relied on the iconic red envelopes for DVD rentals. The decline of Netflix's DVD service also reflects the company's shift away from physical media. For earnings news, Nike is set to report its earnings on Thursday after posting its first earnings miss in 3 years in the previous quarter. Nike has been grappling with a 23% increase in inventory since 2021, which has impacted its performance. The company has been scaling back its direct-to-consumer business and working on improving relationships with wholesale partners like Foot Locker and Macy's in an effort to clear excess inventory. Analysts have modest expectations due to weakening U.S. retail spending, but Nike is hoping that its strong brands, such as the $6.6 billion Jordan line, can boost demand. Lastly, retailers are gearing up for the holiday season by increasing their workforce. Target recently announced plans to hire an additional 100,000 employees to accommodate more curbside orders and in-store returns. Amazon, the second largest private employer in the United States after Walmart, is hiring over 250,000 more workers, 100,000 more than the previous year, and increasing wages as it expands its next-day delivery services. However, holiday hiring is expected to be the lowest since 2008, and 76% of US adults plan to reduce spending during the holiday season. With that being said, thank you for watching. Do not forget to press the like button, and I wish you happy investing.